Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So apologies, we were not able to hold the session earlier at 4 p.m., but all the more we're able to do it now. So before we proceed, I would like to begin with a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and these will confirm that everything is working just fine. So also excuse the rain. We are having very heavy rains over my area, so it might cause some slight disruption in the voice. So the topic for today is pretty interesting. I want us to have a brief update of what's happening in the markets right now. And this is concerning the US banking crisis. So we know that last 2 weeks ago, 3 US banks collapsed. One of the biggest ones was Silicon Valley Bank, or SVB. But then it followed through to other banks. We saw it happening with Credit Suisse and also First Republic Bank, which seems to be having some form of recovery today. So in this crisis, we all know it was as a result of a lot of these banks holding a lot of bonds at par, and they were holding massive unrealized bond losses. But now, in order to try and stabilize the economy, the US has considered backstopping all unsecured deposits. And what this means is that for a majority of the people that hold deposits in US banks, and these deposits exceed $250,000 per account, then any amount of dollar above that is not secured. So what this means is that risk of banks holding unrealized gains, they risk going into collapse or receivership if some form of bank run happens or people start withdrawing their money. The banks don't have sufficient cash to honor deposits. And as a result of the fears that happened 2 weeks ago, a lot of depositors have been withdrawing their money, or in simple terms, forming a mild bank run and transferring their money to bigger banks that have full guarantees. So in order to stop this from happening, remember about 50% of US banking is done by smaller banks. So if all this money was to move to the bigger banks, then the smaller banks would collapse, and it would create a very big problem where the big banks have all the deposits and the small banks collapse or get owned by the bigger banks. So I want us to go through a list of a number of hot takes, and also with an interesting focus on what is happening tomorrow. So let's first of all look at the economic calendar. So as you can see, today was pretty quiet, and inflation came in lower than expected for Canada. But then the most interesting data point is tomorrow, when you look at the UK CPI and also the US FOMC economic projections, FOMC statement, federal funds rate, and FOMC press conference. So the biggest thing that investors are trying to determine right now is whether the Fed will go ahead with this rate hike from 4.75% and push rates to 5% or even 5.5%, or whether they're going to maintain the same level of 4.75% or even go for a rate cut. So all these are on the table, and we don't know how this situation will progress from here going forward. So with this in mind, let's look at some of the hottest takes in the market right now. And once you go through them, then it will be easy to understand what investors are thinking in the markets. So one of the hottest takes is right here. Economists say that they found around 186 banks, and these are regional banks in the US, that may be prone to similar risks such as the Silicon Valley Bank. And this is coming from the Wall Street Journal. So it means that there's more banks within the US system that are holding massive unrealized bond losses. And if clients were to withdraw money from their accounts, then up to 186 banks could be collapsing today. So with this risk holding onto the US financial system, the Fed jumped in and backstopped all these deposits. So by backstopping, it basically means that if these commercial banks need money to honor deposits, then they can get this money directly from the Fed. So second hot take is right here from SL Kanthan. So the US Federal Reserve Bank, or the Fed, just printed about $300 billion out of thin air last week to bail out the banks. What a joke and a voodoo economics. This is not a free market or even capitalism. So if developing nations such as Kenya want about $300 billion, then they probably have to sell their sovereignty to the IMF. And for them, it's just easy money. So it's almost as if we are getting back to a system of easy money. And we all know what happens. So during the COVID period, about $6 trillion were printed, and we saw a lot of stocks rallying and performing really well, including indices, the S&P 500, the NASDAQ, the Dow Jones. All of them were going up extremely well. So in this case, we could be seeing something similar, especially if the US was to print a massive load of money. So on the other hand, the US dollar is expected to weaken if they increase the amount of dollars in circulation. So another hot take is from Treasury Secretary Janet Yellen, where she affirmed commitment to backstop more bank deposits if necessary to the opposition of several lawmakers. So this is the current thing happening in the US. They are considering whether all customer deposits should be secured by the Fed. So what this means is that even if the bank has massive unrealized losses, clients would still be able to access their money. If you go to your local commercial bank and withdraw your money, you have that money, but it will not be coming from the deposit you made. The commercial bank already took massive risks with that money and made losses, and now you're getting the money from the government, which means that the money supply is just increasing in the system. So the other one, maybe the worst is past among the banking sector, and we have seen some kind of resolution with regional banks and the Fed allowing them to backstop their assets. So this is coming from AGA's research, Kevin Hill. So we believe all deposits will eventually be backstopped by the Fed. So that's one take. When you think of the Fed backstopping all deposits, then there's no need to have a bank run. People will not fear about their money or whether they should withdraw from the banks. But at the same time, the bigger problem is one, there will be too much money flowing in the system. And two, banks will not be incentivized to take less risks. They will be incentivized to take even higher risk with their customers' money. And if they lose money, they are guaranteed that the Fed will take care of that. So that's the big moral hazard that is currently happening in the US. So on top of that, there's another hot take here. US banks had about $620 billion in unrealized losses at the end of 2022. And this is according to the Federal Depository Insurance Corporation, or the FDIT. And this is coming from Grit Capital. So as at the end of last year, it was $620 billion. And as the Fed continued hiking interest rates this year and bond yields continued rising, then this number almost doubled. So it's much bigger than this as we speak right now. So from John told, I agree this is not 2008, it's even worse. So the FDIC is now obliterated and the federal government is backstopping uninsured deposits currently valued at about $17 trillion. So the thing is, the Federal Depository Insurance Corporation was not holding that big of a fund to cover all the money that was deposited within US financial institutions. So when you look at all the banks collectively in the US, or all the deposits that people have saved in their banks, this tallies to about $17 trillion. So if the Fed was to provide a cover, it would have to literally create a cover for about $17 trillion. And this would be a massive stimulus in the US economy, which on one hand would create what is being described as hyperinflation, where the prices within the US continue rising way beyond what we saw last June. So another hot take, and this is from Ryan Bachmans. Well, total US commercial bank deposits are $17.6 trillion. And this is a reason to this 145 times larger than FDIC's insurance fund. Of, as far as I can tell, 121 billion before today's backstopping. It seems numerically unrealistic for all deposits to be guaranteed by the government. So after the FDIC rescued the clients of Signature Bank, Silvergate Bank, as well as the Silicon Valley Bank, it was only left with a small amount, which is about $121 billion. So if any other bank was to fail, then these $121 billion will not be sufficient to cover one bank. And this means that the Fed has to chip in, print in even more money in order to cover any other bank failure. So by the Fed creating a new credit line that is set to guarantee all the deposits of about $17.6 trillion, then this would come with a lot of challenges. And this is what the market is currently talking about. This is something that everyone is trying to rationalize. So from RJR Capital, I don't know any middle class or people who have more than 250K sitting in individual bank accounts. So yes, backstopping deposits is a bailout for the rich and for unprofitable companies. Anyone who says otherwise is lying. So the average deposits in the US is roughly about $5,000. So it's not everyone who has a deposit in a commercial bank that goes past 250K in their account. So if a lot of people have balances that are somewhere on average around $5,000, then if the Fed is looking to guarantee monies that are above 250K, then it's a bailout for the rich people, not for the poor people of the US. So it's also a very political issue, which will be a big challenge trying to pass that in Congress. Remember, the US is rapidly approaching an election year. So in this case, we will be seeing a lot of fight happening in Congress, where people try to support their people in order to get political influence. So another one, and this is from Gordon Johnson, backstopping deposits is asking the Federal Reserve to underwrite risk with taxpayer money. It's unacceptable. It's Banana Republic stuff. So it's basically saying that our banks can easily collect deposits from the people, invest these deposits the way they want, take excessive risk. But then instead of underwriting the risk themselves, or basically hedging that risk that they take, then the government takes on that risk, or basically underwrites the risk with taxpayer money. So when this happens, then you know that the system is not working, and this is only a temporary solution. So another take from Jeff Stein, Senator James Langford posed a difficult question. If the US is backstopping SVB and signature deposits, but not those of smaller community banks like those in the state, then why wouldn't people rush to withdraw money there and move them to a bank with federal backstopping? So here is another moral hazard where if you save some small banks and you don't save the rest of them, then it basically means that people lose faith or lose trust in these smaller banks and then push all their money to the bigger banks. It's something that I mentioned earlier in the session. And now going forward, we move on to another one from intraday crude oil trader. Yellen's comments alluding to effectively backstopping all deposits rather than the current 250K has opened up West Texas intermediate crude oil at $70 plus. So market pushing higher already, not waiting for Yellen's speech in 2 hours time. So this is something that we might want to consider. It's something that we talked about yesterday. Brent oil prices managed to form what we call a pin bar towards the end of the session. So if you look at the daily candlestick, it's clearly indicative of a rejection of lower prices. So if I remove these, it will become clear for everyone. So the green candlestick here with a long tail towards the lower side, rejecting a price level of $70 per barrel. So oil bouncing strongly and moving even higher and closing at a high of $73.67 per barrel. So today you can see the continuation, and it seems like oil prices are now beginning to recover after being in this bear market for about a year. So you can see that from April last year, oil prices have been moving downwards, but now it seems like they are finding some energy, and we could be seeing a reversal of the same. So going to a smaller time frame, you will notice that there had been a very strong trend line downwards, but it seems like the market is now bouncing and moving further back upwards. So for the last couple of days, we know that there was a trend line playing along this area here. So market was finding resistance, and resistance here managed to break this towards the end of the session yesterday, retested the area, and then rallied even higher. So there is a good chance we'll be seeing the market retest the area of $75.49 per barrel. And if we break these, then even perhaps higher prices. So this is a potential for today, intraday trading. And as we get to the Fed, especially if it decides to cut interest rates, then we could be seeing some even higher prices for oil. So as we progress, I'd like to take on some feedback. So if you have any questions or comments, keep them flowing on the comment section, and I'll be responding to that right away. So I already see one question. This backstopping and quantitative tightening, how is this? What sense is it to raise the interest rates? And does this mean US government will own a stake in the banks? So it's not owning a stake in the banks because naturally it's lending the money to the banks. So we don't know how the situation will unfold. So the biggest decision being awaited tomorrow, we'll see whether the Fed goes for a rate hike or a rate cut. And the most important part will be the FOMC press conference, where the Fed now clarifies a way forward for US monetary policy and whether they are going to continue printing even more money. So if you have any questions, keep them coming. I'll be responding to them right away. Another one here from Derek Gilbert. This is a completely bad idea. Backstopping all deposits removes incentives for banks to avoid risk. I think this is something we already mentioned. Catering long, people should be allowed to think of their bank deposits as theirs. So when you make more than 250K deposit to a bank, you're making an unsecured loan to a leveraged counterparty that might fail. So for her, she had earlier applied for a full reserve bank, which was not approved by the Fed. So in this case, she's saying that when you deposit money in a bank, then you should be able to view that money as yours. So if the bank goes ahead and trades that amount of money with leverage, then there's a good chance it will fail, and this should not be allowed to happen. So from Bitcoin news, Fed reportedly about to inject $18 trillion into the market. Yes, that's $18 trillion. So $18 trillion being pumped into the market would be purely hyperinflation. The dollar would crumble downwards against other currencies. And as a result, we'll be seeing hard assets rally up. So hard assets basically includes commodities, things that are very hard to find or to mine. So we could be seeing a very strong rally happening in commodities markets, and real estate could be on the rise again, since there will be a lot of money flowing and people will be looking to convert that money into hard assets. So another one, this was from Elon Musk early this morning. Fed needs to drop the rate by at least 50 basis points on Wednesday. So now you can see that there is increased pressure on the Fed to cut interest rates in order to reduce the risk that is currently happening in the US financial system. So next one, and this is Peter Schiff. Investors believe that the Fed pivot will inflate another tech bubble. But this easing cycle, which will include the largest quantitative easing program yet, will send annual inflation rates into the double digits indefinitely. That's bad for the tech sector as it destroys the present value of future earnings. So we know that the tech sector is usually trading at a very high multiple to the PE value or price to earnings ratio. So main reason that you would see a stock like Apple being traded at a higher multiple to its book value is because the investors are pricing in the future earnings of the company. So if it happens that there is a very high inflation as a result of the Fed printing an excess amount of money, then the value of those future earnings would be depreciated and the stock would crumble. Investors would eventually realize this and they would short the stock. So that's one of the key things to be aware about while processing this information. So next one is a detailed letter from Bill Ackman. And he is the CEO of Pershing Square Capital Management, one of the biggest hedge funds in the US. So the Federal Reserve should pause on Wednesday, and by pausing, it means maintaining rates at 4.75%. So you've had a number of major shocks to the system, 3 US bank closures in a week, wiping out equity and bond holders. So the demise of Credit Suisse and the zeroing of its junior bond holders, notably bond holders bearing losses in a few, is a new phenomenon as they were protected by the GFC. So First Republic Bank depositors that haven't left already will not be comforted by today's stock price performance. This banking crisis remains unresolved and higher rates won't help. We don't yet know whether the losses are for investors in these institutions and what the contagion effects may be. Deposits have become unstable. What regional bank is going to commit meaningful capital to new construction or business loans in this context? So when these commercial banks are stretched for capital and they are looking for money to honor withdrawals, then if you are a citizen of the US and you're looking to get a loan to engage in new construction or to engage in business, productive business, the bank will not consider you because it's worried about its liquidity. So the banks may not be incentivized to lend to the economy, and this is a big challenge. So the effect of the above is a meaningful tightening of financial conditions that has not yet been visible in light of the rapidly unfolding events of the last 2 weeks. So he's basically saying that the Fed has been hiking interest rates rapidly in the fastest pace ever. And this is causing financial strains in the system, and it could lead to even worse situations since the rate hikes that were done previously have not had the full effect in the economy yet. So inflation is still a problem, and the Fed needs to continue to show resolve. Powell can do this by pausing and making very clear that this is a temporary pause so that the impact of recent events can be assessed. He can make clear that his intent is to resume raising rates at the next meeting unless the banking crisis remains unsolved and has on its own sufficiently slowed the economy. So he's basically recommending that interest rates remain at the current level and no more rate hikes until we see the full effect of the previous rate hikes before making another decision whether to continue hiking or cutting. So I continue to believe that the best course of action is a temporary FDIC deposit guarantee until an updated insurance regime is introduced. For if bank number 5 is crossed, the market's attention will move to bank 6, 7, and 8. So it's a domino effect. If one bank is collapsing, then investors will start looking at the books, see the next bank that has the biggest unrealized gain, the one that has the largest uninsured deposits. Then we see a bank run in that one, and after that one, the next one, and the next one, and eventually the entire system crumbles. So unfortunately, the data on every bank's assets, liabilities, and deposits are publicly available, and the stock market has been a perfect indicator of who comes next. So if you look at the stock market performance for banks, you're able to identify how they are performing and identify the ones that have the highest risks. So a quick overview, if for instance, we check on the, let's say the FinViz website, you're able to see a highlight of the stocks and how they have been performing. So for instance, since the open of the market today, The stock with the biggest loss is Altimmune Biotechnology. Then we have CheckGap Diagnostics and Research, First Majestic Silver Corporation, and Jeff's Brands, which works in internet retail. Then you have Sigmatron International. So all these are not in the banking sector. In fact, the banking sector has been gaining today. So if you look at First Republic Bank, it's up 43%. And this is upon the guarantee that the Fed will be backstopping its deposits. So this indicates renewed confidence in the regional banks. And with this comes optimism that the banks will perform well because now they have free money. So if you look at ongoing AG, I'm looking for a bank. So I'll be just scanning quickly. So it seems you don't have extremely high volatility, save for First Republic Bank. So it seems like most of them are not printing the same numbers that we were seeing last week. So last week is when we had banks going down 60, 70% within a day. But today it seems like that kind of volatility is reducing. So this is not an environment in which the Fed should be raising rates and adding additional pressure on the system, as financial stability is the Fed's first responsibility. So this is a very important point, and I think it was the major highlight of the release. So if the Fed goes ahead and raises interest rates, then this would add more pressure to the system and increase the risks that the financial stability might not be achieved. And also, if it happens to cut interest rates, then there could be renewed confidence in the system. However, the recommendation for Bill Ackman is to maintain rates at the same level. So a very nice chart here indicating the millions of US dollars that have been added into the system. So during 2021, 2022, the Fed balance sheet was just expanding. And this is total assets less eliminations from consolidation. We saw a peak of around, I think, $9 trillion. Then the balance sheet went all the way back down before rising high in the last 2 weeks. So what the Fed had done over the last 1 year in cutting its balance sheet, it had achieved a drop of about $600 billion. And now $300 billion have been injected into the system within a very short period of time. So the effect of this is increasing dollar supply. And this is purely negative for the dollar index. So if you go back to the charts and look at how the dollar index has performed for the last couple of days, then you can see that there was some confidence that the Fed will go for a 50 basis point hike. This was after Jerome Powell's speech. But then since this period, you can see some further downside after people realized the massive losses being held by banks. So there is a good chance we'll be seeing some further downside in the dollar index. And this means strength in other currencies that are not doing the same thing. So if you look at Euro USD, you can see the strong rally from Thursday, the previous week. So anytime Euro USD has been pulling back, investors have been buying even more and pushing prices higher. So today it managed to break this price level. I remember discussing this morning. So we got to this level, there was a retest, and perhaps you'll be seeing some further continuation. So New Zealand USD, I don't know why it's the only one that is losing to the dollar. If you look at the pound USD, the only loss is today, but over the last 1 week, it was completely bullish. The Canadian dollar was doing well, save for today. So we just had the inflation data, which came in at lower than expected, but then the Bank of Canada has already maintained its policy and said it's not going to do any further rate hikes. So in this case, there's a divergence between what the Fed has been doing and what the Bank of Canada has been doing. However, tomorrow we might be seeing a completely different story. And this different story would be coming, especially if the Fed decides to cut interest rates. So cutting interest rates would completely weaken the dollar, and you could be seeing the dollar going down against other currencies. So as for gold, we mentioned there was a head and shoulder pattern. And after this, the market broke the neckline, and now you're seeing some further downside. So there is a good chance we'll be seeing some further downside happening in gold later on today. So last part of today's presentation, it may seem like the banking crisis started overnight. In reality, this is not the product of, this is the product of the following. One, we had $4 trillion in printed stimulus. This was during COVID. Years of 0% interest rates. This was free money. Fed literally buying bonds and ETFs. This was basically buying all the risk and flooding the market with liquidity. Then 22 straight months of 5% plus inflation. This is a sequence of what has been happening. So now the US is paying for years of free money. So if the Fed came tomorrow with a 50 basis point, slightly unlikely in my opinion, the market will dump so hard that it will cause holes in monitors on daily charts. So that's one of the biggest risks that you have to be aware of heading into tomorrow. And this is coming from Sachin Sharma. So if the Fed goes for a 50 basis point hike, which implies further tightening, then there will be a loss of confidence, and we could be seeing the equity markets dumping really hard. So you have to be prepared for that eventuality. But if it maintains the same level of rates at 4.75%, or even goes for a rate cut, then the expectation is that there will be a rally that will be led by the Dow Jones Index. So that's it. That's the expectation for tomorrow. I hope I was able to shed some light on the current situation. So what's the prediction of the USD in the near future? Downwards. That's very clear. As long as there's more money coming into the market, then the prediction is downwards. So hey, Anthony, and thank you for joining the session. Where did you get the piece of hot picks you're reading, articles, and Twitter? So how will the backstopping affect US treasuries? I think one key thing or one common take from that is that the US treasuries will not have free market. So if a bank is stretched financially, it will not be forced to sell its treasuries. So there's no free market. It's basically depressing supply, and that would cause a large number of implications, which I'm yet to find out. It's a market that will become so crazy since there will be no free market. So a free market is where demand and supply is free. But in this case, there will be no supply because anytime a bank is forced to sell, it has a credit line that they can get right from the Fed. So that's it for today, and I hope to see you guys on the next session.